Hello everyone, I'm Jiang, and welcome to Jiang Decoded. Today, we're going beyond the headlines to explore a question that affects millions of Americans, regardless of their age, profession, or financial situation. Is the United States moving toward another recession? Or are we simply experiencing another period of economic uncertainty? The answer is not as straightforward as many headlines suggest. Some reports point to a resilient economy. Employment has remained relatively strong. Inflation has eased from its recent highs, and financial markets have continued to show confidence. Yet at the same time, many families are paying more for groceries, housing, insurance, healthcare, and everyday necessities than they were just a few years ago. This contrast has created growing uncertainty. If the economy is performing well, why do so many households still feel financially stretched? To answer that question, we need to look beyond individual statistics and understand how an economy actually works. Economic strength cannot be measured by a single number. A growing stock market does not necessarily mean every family is becoming more prosperous. Likewise, slower growth does not automatically mean a severe recession is around the corner. Healthy economies are constantly changing. They expand, slow down, recover, and adapt. These cycles have been part of modern economic history for generations. What matters most is identifying the signals that tell us where the economy may be heading next. Throughout history, major economic slowdowns rarely appeared without warning. Before the recession of 2008, concerns about housing affordability, rising financial risks, and excessive borrowing were already being discussed by many analysts. Likewise, other economic downturns often developed gradually as consumer confidence weakened, businesses became more cautious, and investment slowed. The warning signs were there, but they were often easier to recognize in hindsight. Today's economy presents a different set of challenges. Instead of a banking crisis, economists are paying close attention to inflation, interest rates, consumer debt, housing affordability, and global uncertainty. Each of these factors influences the others. When prices rise faster than incomes, families gradually lose purchasing power. Even if wages increase, higher costs for essential goods and services can leave households feeling financially constrained. This often changes spending habits. Families may postpone vacations, delay purchasing a new vehicle, or reduce discretionary spending. Businesses notice these changes quickly. When customers spend less, companies often become more cautious about expanding operations, investing in new projects, or hiring additional employees. Over time, millions of these individual decisions begin influencing the broader economy. Another major factor shaping today's economic environment is inflation. Over the past several years, inflation increased to levels not seen for decades. Although price growth has moderated compared to its peak, many everyday expenses remain significantly higher than before. For consumers, the important question is not simply whether inflation is falling. It is whether incomes are growing fast enough to restore purchasing power. For many households, that adjustment takes time. Housing remains another important challenge. Higher mortgage rates have made homeownership less affordable for many first-time buyers. Existing homeowners who secured lower mortgage rates in previous years are often choosing not to move, reducing the number of homes available on the market. This creates a complicated situation. Demand remains strong in many areas, while affordability has become increasingly difficult. The result is a housing market that continues to influence construction, consumer spending, local businesses, and overall economic activity. But perhaps the most important question facing policymakers today is this: how do you slow inflation without slowing the economy too much? To reduce inflation, central banks often increase interest rates. Higher borrowing costs can help reduce excessive demand, but they also make mortgages, business loans, and consumer credit more expensive. Finding the right balance is one of the most difficult tasks in economic policy. Raise interest rates too aggressively, and economic growth may weaken more than intended. Reduce them too early, and inflation could begin rising again. This balancing act explains why economists continue debating the direction of the American economy. Some believe the country is moving toward what is often called a soft landing, where inflation gradually returns to more stable levels without triggering a significant recession. Others argue that the full effects of higher interest rates have not yet worked through the economy and that slower growth could still emerge over the coming months. At this stage, neither outcome can be treated as certain. That is why understanding the broader picture matters far more than reacting to individual headlines. Because when people focus only on today's news, they often miss the long-term trends quietly shaping tomorrow's economy. And those trends become much clearer when we examine the role of American consumers, household debt, employment, and business confidence. To understand where the American economy may be heading next, we first need to look at one of its strongest foundations, the American consumer. Consumer spending accounts for the largest share of U.S. economic activity. Every day, millions of people purchase groceries, pay rent or mortgages, fuel their vehicles, travel, dine at restaurants, and shop online. Those individual purchases collectively support businesses, create jobs, and drive economic growth. But consumer confidence is not unlimited. When people become uncertain about their financial future, they naturally become more cautious with their money. That caution may begin with small decisions, postponing a vacation, delaying the purchase of a new car, or waiting a little longer before renovating a home. Individually, these choices may seem insignificant. Across an entire nation, however, they can gradually slow economic activity. One reason economists continue monitoring consumer behavior so closely is the growing level of household debt. Many Americans use credit responsibly to manage everyday expenses and long-term investments. However, when borrowing costs rise alongside higher living expenses, managing debt becomes more challenging. Higher interest rates increase the cost of carrying balances on credit cards, financing vehicles, and taking out new loans. For households already working within tight budgets, even modest increases in monthly payments can reduce financial flexibility. This does not automatically indicate an approaching recession. However, it does suggest that many families have less room to absorb unexpected financial shocks than they did when borrowing costs were significantly lower. Employment tells a similarly complex story. The American labor market has remained remarkably resilient despite higher interest rates and slower economic growth. Many industries continue hiring, unemployment has remained relatively low by historical standards, and businesses in sectors such as healthcare, technology, and professional services continue searching for qualified workers. These are encouraging signs. Yet, economists rarely evaluate employment using a single statistic. They also examine hiring trends, job openings, voluntary resignations, wage growth, productivity, and business confidence. Why? Because employment often reflects where businesses believe the economy will be several months from now, not simply where it is today. When companies become uncertain about future demand, they rarely begin with immediate layoffs. Instead, many slow recruitment, delay expansion plans, postpone major investments, or reduce temporary hiring. These early adjustments often occur quietly, long before they become visible in national headlines. Another important area attracting attention is the housing market. Housing has historically served as one of the strongest indicators of broader economic activity. When mortgage rates increase, affordability declines. Some buyers postpone purchasing homes, while some sellers choose to remain where they are rather than giving up lower mortgage rates secured in previous years. This creates lower transaction volumes across many regions. The effects extend beyond real estate itself. Construction companies may receive fewer new projects, furniture retailers experience weaker demand, home improvement businesses may see slower sales, mortgage lenders process fewer applications. Even local service providers, from moving companies to appliance installers, can feel the impact. Housing demonstrates an important economic principle. No industry operates in isolation. Changes within one sector often ripple throughout the broader economy in ways that are not immediately obvious. Financial markets also deserve careful attention. Stock markets are often described as forward-looking because investors continuously evaluate what they believe companies may earn in the future, rather than focusing only on present conditions. This explains why markets sometimes appear disconnected from everyday life. Share prices may rise, while households continue facing higher living costs. Likewise, markets may decline even when unemployment remains relatively low. Investors respond not only to current economic data, but also to expectations about inflation, corporate earnings, interest rates, technological innovation, government policy, and global developments. For long-term investors, this serves as an important reminder. Short-term market movements rarely tell the complete story of the economy. Economic growth depends on far more than daily fluctuations in financial markets. Another factor shaping today's outlook is business investment. When companies feel optimistic about future demand, they often expand operations, invest in new technology, build additional facilities, and hire more employees. When uncertainty increases, those same businesses may become more cautious. Expansion plans are delayed. Large purchases are postponed. Hiring slows. These decisions may appear conservative from an individual company's perspective, yet collectively they influence economic momentum across the country. This brings us to one of the most challenging responsibilities facing the Federal Reserve. Its objective is to support long-term economic stability while maintaining price stability. That requires balancing two competing risks. If interest rates remain elevated for too long, economic activity could slow more than intended. If borrowing costs are reduced too quickly, inflationary pressures could return before prices have fully stabilized. There is no perfect formula. Economic policy often requires making decisions with incomplete information while responding to conditions that continue changing over time. That uncertainty explains why economists frequently disagree, not because the data are necessarily inaccurate, but because the future depends on countless decisions made by households, businesses, investors, governments, and events occurring around the world. Rather than searching for certainty, it is often more useful to examine the range of possible outcomes. And that brings us to the most important question of all. So, where does all of this leave us? After examining inflation, interest rates, consumer spending, employment, housing, and financial markets, one thing becomes clear. The American economy is not sending one simple message. Instead, it is sending several different signals at the same time. Some point toward resilience. Others suggest caution. That is why economists continue debating whether the United States is heading toward a soft landing, a mild recession, or simply a slower period of economic growth. Rather than trying to predict the future with certainty, it is more useful to prepare for the range of possibilities. Based on current economic conditions and publicly available information, I believe there are three realistic scenarios worth watching. Scenario 1, a soft landing. This is the outcome many policymakers hope to achieve. Inflation continues moving closer to the Federal Reserve's long-term target, while employment remains relatively strong. Consumer spending slows gradually rather than collapsing. Businesses continue investing carefully, and financial markets remain relatively stable. In this scenario, economic growth moderates without entering a significant recession. It would not feel like a perfect economy, but it would represent a relatively stable adjustment after several years of unusually high inflation and rapidly changing monetary policy. Many economists believe this remains a realistic possibility if inflation continues easing and the labor market remains resilient. Scenario 2, a mild recession. The second possibility is a more traditional economic slowdown. Higher borrowing costs gradually reduce consumer spending, business investment weakens, hiring slows, and unemployment begins rising over time. Rather than a sudden financial crisis, this scenario would likely develop gradually. Economic growth could weaken for several quarters before beginning a recovery. While this would create challenges for households and businesses, history suggests that most recessions eventually give way to renewed growth as economic conditions stabilize. Scenario 3, an external shock. The third possibility depends less on domestic economic conditions and more on unexpected global events. Major disruptions to energy markets, geopolitical tensions, supply chain interruptions, natural disasters, or unexpected financial instability could place additional pressure on an economy that is already adjusting to higher interest rates. Events like these are difficult to predict. However, they remind us that modern economies are deeply interconnected. A disruption affecting global trade or energy supplies can influence inflation, transportation costs, business confidence, and financial markets far beyond the country where the event first occurs. This is why economists monitor not only domestic indicators, but also developments across the global economy. So, which scenario appears most likely today? The honest answer is that no one knows with certainty. Economic forecasting has always involved uncertainty. History is filled with examples where experts underestimated risks, just as there are examples where predicted recessions never fully materialized. That uncertainty is precisely why responsible analysis should focus on probabilities rather than guarantees. At this moment, the available evidence suggests that the United States continues to demonstrate considerable economic resilience. Employment remains comparatively strong. Businesses continue adapting to changing conditions. Innovation, productivity, and entrepreneurship remain important strengths of the American economy. At the same time, higher borrowing costs, elevated household debt, persistent affordability challenges, and global uncertainty continue presenting meaningful risks that deserve careful attention. The most valuable lesson may not be whether a recession begins next month or next year. The more important lesson is understanding how economic cycles work. Periods of rapid growth are often followed by slower growth. Financial markets rise and fall. Interest rates change, consumer confidence strengthens and weakens. These cycles are a normal part of modern economies. Preparation is generally more valuable than prediction. For households, that may mean maintaining an emergency savings fund, managing debt responsibly, avoiding financial decisions driven by fear, and focusing on long-term financial planning instead of reacting to every headline. For investors, history has repeatedly shown that disciplined, long-term strategies often prove more resilient than emotional decisions made during periods of uncertainty. Most importantly, remember that headlines are designed to capture attention. Real economic change usually develops gradually. The most significant trends often begin quietly, long before they dominate the news. That is why understanding the underlying forces behind economic change is far more valuable than simply following daily headlines. The goal of this channel is not to predict the future with absolute certainty. It is to understand the historical patterns, economic principles, technological developments, and global events that help us make better decisions in an increasingly complex world. Because informed decisions begin with informed thinking. If you found this analysis helpful, consider subscribing to Jiang Decoded for more evidence-based discussions on economics, history, technology, geopolitics, and the ideas shaping our future. Thank you for watching. I'm Jiang, and I'll see you in the next video.